the 10-year Treasury yield was coming down, and job openings popped to 9.6 million. They were supposed to fall from 8.9 million to 8.75 million. So huge jump there.
Big jump. Yeah. Yeah.
That is absolutely not what the Fed would want to see. So yeah, that's pretty much what's going on there.
Good point.
David, I see a lot of questions as someone, people asking, where do I get over 5% on my money? And I look at Schwab's got a Schwab Treasury Obligations money fund, ultra shares. That's the 7-day yield is 5.2% on that. And the symbol, at least if you with Schwab or TD Ameritrade, SCOXX. And then on Fidelity, Fidelity has also a 7-day yield, 5.3%. And it's Fidelity, it looks like institutional money market portfolio. It's 7-day yield is 5.3%. So that's where you can get over 5% on your money. Now that's going to move. It's going to be moving with interest rates. So if it keeps on going up, it'll go up with interest rates. If it starts coming off, then that yield will fall. You're not locked in, I guess, on these because they're constantly moving with interest rates.
That's right. And I'll try to get the exact ticker. I tried SCOXX, David, but that didn't register. I'm not really sure why.
If you're on, but I think if you're on the Schwab platform,
yes,
that's what they use. I don't think it's something that it's not like an ETF that you can buy. It's the same thing with Fidelity's. If I guess because I have accounts at both of these institutions, and Fidelity's is FMPXX, but you put that in and it won't come up on MarketSmith. It's probably something internal to them, but that's if they have accounts at those places, then that's where they can move money to get that type of yield.
And also there would be nothing to see on the chart,
because
they try to peg it at 1, so the money market fund, so it would just be a flat 1.
That's right. And we have some of those charts on MarketSmith too. The suggestion I heard from a money manager who was at the AAII LA chapter recent presentation at the Screwball here in LA, Nick Atkinson, big IBD fan, he suggested looking at Spider Bloomberg 1 to 3 month T-bills. Evidently has a pretty low expense ratio, and this is a really interesting looking chart. I cannot explain why it goes up and down like that.
It's because it's a constant distribution. Right, so
it must be, yeah. It's regular, right, Justin? Yeah,
it's like, so
okay,
you're getting a constant distribution, and so that that distribution, it's just putting money from one pocket to the other. You're not losing that money, but it shows up on the chart because it's no longer part of the stock price. It's money that gets distributed,
right? Thank you, Justin. And also, make sure when you have your online broker or whoever you work with, you specify whether you want the dividends or the interest payments to be reinvested in that same security or just to be received as a cash dividend and plunk it right into your account as cash. All right. And there's obviously tax considerations for both. The Russell 2000, meanwhile, IWM on MarketSmith down about 0.9%, now down 1%. So indeed, Ed, with the Treasury, 10-year Treasury 4.74, it looks like we've eclipsed yesterday's highs, right?
Yeah, I mean, and we were actually coming down a little bit, intraday, and
that's right.
It was, and that was why these stocks were coming back up, and that's going to pop up again. It's just unrelenting. I mean, it's like that has to stop. I mean, maybe stocks can bottom and level off if the 10-year Treasury could just level off. I mean, I think we have to get used to it. This is going to maybe the new normal. I mean, the 2008 to 2022 of zero interest rate policy that we had, that's gone. Okay, inflation may come down, but we're not going to get it. And I'm not saying the 10-year Treasury will stay here. I mean, it could fall some, but that enormous period where interest rates were so low, and there's a lot of things you could argue that maybe we're Treasury yields with it. I mean, it's sort of a vicious circle because deficits are so large that's making people worried, and treasury yields are rising. And of course, that makes debt interest payments much more. If we get a couple of years of this, our interest payments on our massive debt of 33 trillion is going to explode. And so the forecast and most of the forecasts, if you look at them, that assumes tax cuts expire and there's no new spending. And it's like, well, there's no appetite for that to end. So anyway, that's my little rant. There's a lot of reasons why you think that whole policy from 2008 to 2022, that's done, and we're not getting that back. And maybe we level off and then we rally again. I mean, obviously stocks have done well. Where treasury yields are up at 4 or 5%, but the relentless rise has to stop.
Just want to show another chart of the 10-year treasury. Can you guys see this one from macrotrends.net? Maybe I didn't share it properly. You do? Oh, okay, good. Okay. Yeah, so here we go. Talking about what, here, let's go to the 20-year. Well, I think this works out. 2008, you can see the 10-year was at 1.65. And Ed, just to confirm, back in the end of 2008, did we go to like 0.25 on the Fed funds?
If we didn't, we came very close.
We came very close. Okay.
Yeah, and then we also have to consider we loaded up on treasuries, and that the Fed was buying assets through much of this period. They didn't stop buying treasuries until early 2022. I mean, it's that recently we were loading up more assets, and now they're selling them. So it's just going. That policy is going to be done because there's a lot of reasons why you'd think inflation would be higher, even if everything was back to normal. China's not going to be the disinflationary force it was. There's all these things that you would think we're becoming more protectionist, and maybe there's good arguments for it, but that usually means higher prices. So there's a lot of reasons why you think inflation is going to be significantly higher than we saw for a long stretch. So that's my happy note for the day.
Yeah, we appreciate that. And 4.74 is going to be now the highest level since roughly July, maybe August of 2007. New 16-year highs for the treasury yield.